As we venture into 2017, many questions confound our industry. Has undesirable number one been eradicated? Will the global economy stabilise? Has he who shall not be named returned? Will there ever be enough brands for millennials? Before we depart on our journey, let's look at 2016's performance. All of the key metrics exhibited growth, and remarkably, every single metric ended the year at a record level. The food and beverage side of the hotel business has seen very modest growth, only a 1.4% increase in food and beverage revenue per available room in 2016. Nevertheless, the hotel industry is depositing more money in the bank. Over the past 5 years, total industry revenues have increased at a rate of 6.8% annually, reaching nearly $190 billion in 2015. Once 2016 revenues are counted, we expect them to surpass the $200 billion threshold for the first time ever. Moreover, net operating income grew at an astonishing pace of 11.1% annually through 2015, and likely grew further in 2016. While many fear dark times are upon us, the data appears to say otherwise. The volume of air passengers rose 3.1% to a record level in 2016, and that growth is anticipated to continue. Despite the strength of the dollar and concerns abroad, international visitation to the US was expected to end 2016 down a mere 0.9%. International travel is projected to increase in 2017, reaching a record level. GDP for the US grew a modest 1.6% in 2016 and is expected to accelerate in 2017 to 2.3%. Unemployment dropped 0.3 points in 2016 and is expected to slide further this year. Disposable income grew 2.1% last year. Consumer confidence rose an astounding 16.8 points, ending the year at its highest level in 15 years. The Baird STR Hotel Stock Index inflated almost 20% in 2016, and the leading economic indicator was up 0.6% to start the year. As Sirius Black said, "We've all got both light and dark inside us. What matters is the part we choose to act on." On a universal level, the hotel industry appears fundamentally strong. However, one needs to investigate the details to truly see the full picture. Tracking the growth of demand in 2016, you can easily see which locations are up to no good. The vast majority of submarkets saw demand rise in 2016. Still, there were several that did not fare so well. The submarkets depicted in brown experienced declines in demand, and to no surprise, the bulk of those are located in oil and gas regions. Sorting through all 639 submarkets yields some interesting finds. Only 54 submarkets suffered demand declines of 3% or greater, and only 69 encountered RevPAR declines of 3% or greater. Of those 69 submarkets, 50 are in oil and gas areas where the low price of oil has impacted demand. 6 are in South Florida, which has been impacted by the strong US dollar, Zika fears, and new supply. And 3 are in New York City, which is also dealing with extensive supply growth and the weakened European currency. Looking to the future, the dollar is expected to remain strong, and supply growth in some markets will continue to blossom. Nonetheless, Zika fears have subsided for Florida, and regardless, the state enjoyed a record year of tourists in 2016. Additionally, the escalating price of oil is already reviving demand in some regions. The goblet of data is the impartial selector in discovering those markets deemed to be worthy champions. 8 of the 164 US markets have overachieved with high occupancies, solid rate improvement, and demand growth outpacing new supply, all while new hotel construction has shown restraint. 7 additional markets clearly have solid potential, although their development pipelines are rather large. And of course, there are 6 markets lagging in positive attributes at the moment, and all of them dependent on demand from the energy sector. With occupancies at peak levels, rate growth is now the primary driver of RevPAR expansion. Breaking it down property by property reveals further clarity on how room rates are growing. This shows the percentages of hotels with ADR growth and those with ADR declines from 2001 through 2016. Those below the benchmark had ADR declines, while those above experienced increases. In 2015, more than 80% of hotels increased their ADR. However, the percentage for 2016 tapered slightly to 75%. When we break it down further into buckets of 5% increments, we can see an even clearer picture. The darker red shows a more significant decline, while the darker green shows a more significant increase. In 2016, 39% of hotels increased their ADR by more than 5%, and 15% grew rates by more than 10% last year. The demand mixture continues to baffle some, particularly as it relates to the group segment. In 2005, group business comprised of almost 40% of room night demand. Today, the group segment accounts for less than 1/3 of our demand base. Group demand has only grown 2% since the last market peak. Meanwhile, transient demand has surged 34% over that time frame. While the wand chooses the wizard, the developers are clearly choosing their preferred chain scales. The upscale and upper mid-scale lodging products dominate the supply pipeline, comprising of roughly 2/3 of the rooms under construction. The concern of oversupply continues to slither across our industry. Nevertheless, the current level of supply growth is 1.6%, still below the long-term average of 1.9%. Even with the accelerating pipeline, supply growth will not hit 1.9% until later this year. Everybody cheers for a winner, and as hotel companies look to grow, many are focused on creating new brands to win over the multitude of different guests. So far, we've added 31 new brands to the mix since 2010. In the previous decade, we introduced a total of 25 brands, and in the 1990s, we debuted a stunning 46 new brands. We've also seen some brands retire via consolidation or renaming. So when you look at the net gain in brands in recent years, you see that our current pace of brand additions will meet, if not exceed, the extensive brand growth we saw in the 1990s. Most striking is the fixation on soft brands in this recent cycle. From an investment perspective, 2016 was somewhat subdued, with property-level transaction activity at a low point for the cycle. Some may fear this is a sign of the Dark Lord's imminent return. Yet asset pricing remains strong, and the total investment per room for acquisitions maintains an upward trajectory. On our journey through the market cycle, we see the steady rise in room rates after occupancy stabilised in 2006, followed by a slide in occupancy in late 2007 and then a free fall in room rates until early 2010. Through the recovery and ensuing economic expansion, occupancy has reached new heights above 65%, while rate growth has been modest yet consistent. The current prophecy shows steadfast occupancy and climbing room rates through 2018. From the perspective of hotel lenders, 1/3 of those surveyed believe the biggest threat to the hotel industry is the US economy, which is obviously beyond our control. Supply growth is the largest concern within the industry itself. While there is apprehension around the US economy, the hotel industry cycle is expected to maintain its current path. Most of the key indicators within the industry and in the greater economy are moving upward. Thus, the outlook for our industry remains bright. Yet, if darkness should change that course, remember, as Albus Dumbledore once said, happiness can be found even in the darkest of times if one only remembers to turn on the light.